Hello everyone, today we are going to present our research on stock portfolio optimization based on deep learning models and categorical features. In recent years, time series forecasting has become a popular approach for predicting stock prices. However, there are still major challenges. First, even if a model achieves high prediction accuracy, it doesn't guarantee high investment returns. Second, predicted stock prices cannot be directly translated into investment decisions. And finally, focusing on individual stock predictions cannot effectively address the bigger issue of asset allocation. Next, introduce the main objectives of our research. First, we apply feature engineering to convert stock prices into categorical features and combine them with traditional numerical technical indicators. This allows us to capture both trend patterns and technical signals more effectively. Second, we compare the prediction performance of several deep learning models. We also experiment with combining different models to see if it improves accuracy. Finally, we aim to turn model predictions into real, investable portfolio strategies, not just predictions, but decisions that can potentially lead to better returns. For this study, we used data from NTUT Taiwan Top 50 ETF, also known as 0050. The time range of our dataset spans from January 1, 2010 to April 30, 2025. The dataset includes features such as opening price, closing price, highest price, lowest price, and trading volume. From the 5 original columns in the dataset, opening price, closing price, high, low, and volume, we generated a total of 23 features, 13 numerical features and 10 categorical features. We conducted a correlation test using 4 methods: elastic net regression, random forest, mutual information, and correlation. The testing process began with an ensemble feature selection approach to perform an initial evaluation of all features. Next, the scores obtained from each method were standardized, and a weighted integration was performed based on the R-squared performance of each method, in order to calculate a comprehensive score for each feature. After the comprehensive scores were calculated, a candidate threshold was applied, defined as the mean plus 0.5 times the standard deviation. Finally, only the features with scores exceeding this threshold were retained as the input variables for subsequent model construction. Based on the previously described correlation testing process, the candidate threshold for feature selection was set to 0.5. After evaluation, a total of 12 features achieved a comprehensive score higher than this threshold and were therefore selected as input features for subsequent model training. The research framework is divided into 4 main parts. First, we build and evaluate 5 different deep learning models for training and performance assessment. Second, after training, we use the test set to predict the return rates of stocks. Third, the predicted returns are ranked, and the top 10 stocks with the highest predicted returns are selected. Finally, we apply mean variance optimization, MVO, to assign investment weights among these top 10 stocks, aiming to achieve an optimal balance between risk and return. Today, I'll briefly introduce 5 models we evaluated for our task. First, CNN captures local features with convolution and pooling, using dropout for regularization. LSTM excels at sequence modeling with memory gates and split branches. The CNN LSTM hybrid leverages both spatial and temporal features. Next, TCN LSTM introduces dilated convolutions and residuals for multiscale learning. Finally, ADA WaveNet uses adaptive wavelets, attention, and BillSTM for powerful multiscale time series modeling. Each model balances complexity, accuracy, and efficiency for different scenarios. Mean variance optimization is a key method in portfolio theory. Its objective is to maximize return for a given risk, or minimize risk for a target return. It uses mean and variance as core risk-return metrics. By solving a quadratic optimization, we determine the optimal asset weights. The outcome is the efficient frontier, showing the best possible risk-return trade-offs. This approach offers a clear, quantitative strategy for portfolio allocation. For model optimization, we use an 8-to-2 train test split, with 2,954 training and 724 testing samples. To ensure robust validation, we apply 10-fold time series cross-validation, preserving data order to prevent overfitting. For portfolio optimization, we adopt SLSQP, a powerful method for solving continuous constrained problems. Finally, portfolio weights are rebalanced every 20 trading days to adapt to market changes. This setup balances reliability, adaptability, and optimization accuracy. We evaluated model performance using 4 metrics: return, volatility, Sharpe ratio, and max drawdown. CNN leads with the highest return, 48.5%, and best Sharpe ratio, 2.70, showing excellent risk-adjusted performance. CNN LSTM follows with strong results but slightly higher risk. TCN LSTM and ADA WaveNet offer solid balance between return and risk. LSTM is the most conservative, with low return and the smallest drawdown. All models outperform the 0050 ETF benchmark, especially in risk-adjusted terms. Overall, CNN is the top performer. Our analysis reveals 3 key insights. First, the CNN model delivers the best performance, with nearly 50% annualized return, proving its strength in capturing market patterns. Second, combining deep learning with mean variance optimization significantly improves risk-adjusted returns across all models. Third, the 0050 ETF lags behind, with the lowest return and highest risk, highlighting the advantage of our optimized approach. In short, CNN with MVO is the top choice for superior, risk-efficient investing. Our models show strong results, but there are limitations. First, high computational demands make them less practical for smaller investors. Second, they're tailored for 20-day midterm strategies, not suitable for long-term or high-frequency trading. Lastly, real-world use must weigh these constraints against investment goals. Despite this, our work offers valuable insights and a foundation for future improvement. Our strategy combines AI stock prediction with mean variance optimization, focusing on the top 10 predicted stocks to boost capital efficiency. This dynamic, data-driven approach consistently outperforms the 0050 ETF in both return and risk. It's not only effective but also practical and transparent, making it suitable for real-world investment platforms. Overall, we present a next-gen portfolio framework that blends AI with sound risk management.